With pleasure. Scope is a challenger in the world of credit rating agencies. We are a European upstart facing tough competition from the US incumbents. If we look at the industry's history, it becomes easier to understand why investors and issuers need a new rating agency like ours, particularly in Europe. Investors have wanted reliable, independent assessments of investment securities to reduce the risk of losing their money ever since the birth of modern capital markets in the 19th century, if not before. It was increasingly badly needed in the wild days of frontier capitalism in the US. This is in essence the history of the expansion of the railways from the east to west coast, la conquête de l'Ouest, which opened up to the whole country to economic development. Some smart entrepreneurs realized that providing reliable financial data and credit opinions to go with them was a good way to help protect investors. Business owners began to realize too that it was a lot easier to raise money if a respected third party made it known that their credit was good. Merchant debts were the first to be rated, but the industry came into its own with the vast amounts of money borrowed to fund the railways in the late 800s and early 900s. The names of some of those entrepreneurs who provided the first data and ratings on railway and other corporate debt are the ones we still associate with credit ratings today, Messieurs Poor, Moody, and Fitch. To understand today's credit rating industry, we need to fast forward several decades. The liberalization and globalization of capital markets from the early 1970s explain both the huge growth and the concentration of power in the modern credit rating industry. That concentration is quite dramatic. The oligopoly of US agencies led by Standard & Poor's, Moody's and Fitch has roughly 90% of the market. The three agencies rate trillions of dollars worth of debts issued every year. Warren Buffett, an investor in Moody's, has described the company as part of the natural duopoly with incredible pricing power. We can see why Moody's had an operating profit margin around 50% in the year to end December 2020. Of course, the established US agencies were well placed to take advantage of the exponential growth of bond market volumes and growing variety of credit products as financial markets were liberalized around the world in the 70s and 80s. But it is also the case that the barriers to entry for new players is very high in our industry. One barrier is regulation. Regulators are naturally hesitant to let just any company start credit rating to avoid the risk of poor quality rating starting market panics. This has the paradoxical effect of protecting the incumbents apart from the big three. Only 6 other firms are nationally recognized statistical rating organizations, NRSROs, in the US, even after all the criticism S&P, Moody's and Fitch received for their part in the subprime crisis in 2007-2008. These other firms have a very small share of the market. Secondly, big pension funds and asset managers have long-standing investment policies which preclude them from investing in securities which aren't rated by the incumbent agencies. Thirdly, the US agencies have had such a long head start over new arrivals that they have become part of the plumbing of financial markets, embedded in bond markets, contracts, settlement systems, data distribution sites, making them even harder to dislodge. The Scope Group was founded in Berlin in 2002 by Florian Schoeller, Scope Group's chief executive, as a firm specializing in the analysis of alternative investments. Like many, Florian was profoundly affected by the global financial crisis, particularly its effect on Europe in 2007 and 2008. So in 2011, Scope's shareholders and management decided that the firm would expand into rating credit with the goal of creating the European alternative to the US rating agencies. To build a platform for developing the new business, Scope acquired PSR Ratings, an ESMA-registered company specialized in analyzing companies in the automotive sector. Our next step was to grow internationally across relevant rating classes while building our reputation for the highest quality credit assessment. We hired several experienced and established analysts and managers between 2013 and 2015 to ensure that we had the industry leading standards of quality and professionalism. Acquisitions have continued. In fact, we are the leading European consolidator of the region's fragmented rating sector, which is made up of lots of small specialist agencies. In mid-2016, we acquired Ferry Euro Rating Services AG. In January 2021, we acquired EMS Rating. Today, Scope Ratings, a wholly owned Scope subsidiary, is the market leader among European rating agencies. Scope's three main operating units, including Fund Specialist, Scope Analysis, and Scope ESG, offer a full suite of financial and non-financial ratings and services. We cover all asset classes: sovereign credits, corporate, financial institutions, structured finance, project finance, and ESG. Institutional investors have access to all rating agencies on Scope 1, our innovative digital platform. Today, we are a pan-European business. We have around 250 people in Berlin, Frankfurt, Hamburg, London, Milan, Madrid, Oslo, and Paris, our biggest hub outside Germany. None of this would have been possible without considerable investment. Scope has raised financing from investors across Europe over the past 5 years. Scope's shareholders have invested around 80 million euros, including from institutional investors from 4 countries in 2017 and 2018. Stiftung, one of Germany's largest foundations, was in the latest institutional investors to show its confidence in our growth and becoming a shareholder in 2019. At Scope, we believe passionately that this is exactly what Europe needs. But it is not just us. Europe's policymakers have long recognized the region's need for its own strong independent financial institutions for several reasons. First, the global financial crisis of 2008-2009 and the European sovereign debt crisis of 2011 exposed Europe's vulnerability in the realm of credit ratings with issuers. Governments, banks, corporates, and investors reliant on credit opinions of the oligopoly of North American credit rating agencies, often poorly adapted to the realities on the ground in Europe. Secondly, there is the steady push by the EU to develop Europe's capital markets to narrow the gap in their depth and breadth compared with the US. The Capital Market Union, whose goal is to create a strong and unified EU capital market, is of significant strategic importance for Europe's economy. Thirdly, the economic shock of the pandemic has shown how indispensable it is for citizens of Europe to have strong, independent institutions with a stable European identity. This applies both politically and economically levels, not least in the increasingly integrated financial sector. In this context, we offer investors and issuers a European perspective on both credit and ESG. Our rating approaches and methodologies are based on a deep understanding of European realities. Let me give you 2 different sorts of examples. Scope is the first European credit rating agency to issue supranational ratings. Essential to our approach is the recognition that supranational institutions are not commercial entities, whether they are international bodies owned and controlled by governments that provide them with financial resources, credibility, regulatory frameworks, and the liquid capital markets to raise funds to support government policies. Our supranational ratings in Europe include the EU itself in addition to the EIB, based in Luxembourg, the European Stability Mechanism and the European Financial Stability Facility. Perhaps of more interest to those whose day-to-day focus is corporate finance, our corporate rating methodology includes a distinctive mix of quantitative and qualitative analysis. In other words, we rely on a thorough understanding of a company's underlying drivers of business and financial risk, while leaving room for the opinions of the analyst, the local and regional context, and common sense. Our approach to assessing liquidity management also displays our European perspective, setting us apart from the US agencies. We recognize that European companies are typically willing to hold large cash balances to guard against risk. Similarly, we believe pension liabilities justify different debt treatment in some conditions, as they have very different repayment schedules to loans and bonds. Another distinction of our European approach is recognizing the importance of the credit impact of the diversity of ownership structures, including the predominance of family-owned companies, even among Europe's biggest and most successful firms, such as those in the leading indices such as CAC 40, BEL 20, DAX 30. We took a big step forward in this regard in 2020 by creating the Scope Foundation, whose raison d'être is to protect and promote Scope's independence and Europe identity. Florian Schoeller and anchor shareholder Stefan Quandt transferred 20% of the share capital of the holding company Scope Management SA to the Scope Foundation to fulfill its purpose. Scope Management SA performs corporate management functions for Scope Group. I can't put the importance of this any better than Jean-Claude Trichet, a member of Scope's Foundation Honorary Board. Trichet said at the time that Europe more than ever needs a strong and independent European rating agency. The Scope Foundation is making an important contribution to ensuring that the company's European identity endures. The Foundation will ensure that Scope's existing anchor shareholders retain the appropriate influence over Scope's management and strategy. The Foundation will also ensure that Scope remains in the hands of European anchor shareholders in the long term. The leading figures from business and finance who make up the Foundation's Board of Trustees and Honorary Board will offer their expertise and counsel to the Scope Group. Backed by the Foundation, we feel Scope has a key role to play in safeguarding and promoting Europe's economic and financial independence, enhancing Europe's economic sovereignty. To that end, we will have done the preparatory work for Scope ratings to apply for Eurosystem Credit Assessment Framework (ECAF) status with the European Central Bank in 2022. We will be the only European credit rating agency to do so, as well as NRSRO status in the US for the benefit of US investors investing in Europe. Well, one measure of the difference we are making is that a growing number of leading international groups are showing their confidence in the European perspective that Scope offers in their ratings, including Barclays, Daimler, Lufthansa, Fnac Darty, Marc, Sanofi, Santander, Turner, Unicredit, Vonovia. Altogether, we rate more than 200 non-financial corporates across Europe. Another is that the Capital Market Union is slowly but surely helping transform the European economy. The CMU addresses the fragmentation of European financial markets by creating capital market alternatives for European companies which are still heavily reliant on bank loans for funding. Deeper, more liquid credit markets would particularly benefit SMEs and backers' infrastructure projects, particularly as Europe plans to invest heavily in ensuring sustainability post-pandemic growth. The COVID-19 crisis and the EU multi-billion euro recovery program make this more urgent, especially as policymakers, issuers, and investors are paying more attention to sustainable growth. We have a crucial role to display in this financial ecosystem as a vital link between investors and issuers. Let me give you 3 practical examples of what this means. One of our fastest growing franchise is rating securitization, notably packages of non-performing loans sold to investors by banks in the euro area as they seek to bolster their balance sheets and increase their capacity to finance economic growth in the region. We are also the only credit rating agency selected to evaluate and rate ex ante the French Recovery Participatory Loan Fund, Fonds Préparticipatif Relance. The massive 11 billion euro program has been co-created by the French Ministry of Finance, Economy's Recovery, FFA, and major French banks to finance and enhance France's economic recovery through a dedicated SME fund, 30% guaranteed by the French state. Being at the core of the ecosystem in the middle of the equation between issuers and investors is our DNA. In terms of non-financial rating, Scope's ESG is offering, as an illustration, a second-party opinion service for green bonds and labeled ESG bonds having received the appropriate approvals of both ICMA and CBI. Scope has a unique value proposition in this field since it is positioned on ESG impact and the supply chain analysis. In the weeks and months ahead, we are sure to have more news for you which shows how Scope's role in facilitating the financing of the real economy in Europe is growing and how we are further enhancing our pan-European credentials. Watch this space.